Hi everyone! Wall Street closed with losses last week, notching its two-week losing streak. Bulls are unwilling to enter the market. It appears bearish pressure on stock persists. However, currently this is a corrective decline. The downward movement is not so steep to talk about a trend reversal. In January, stocks managed to finally break out of the prolonged downtrend. It's a bull market now. Traders should remain cautious, though. If risk appetite is weak for a long time, the main stock indices may drop below the range of the current trend. As for the S&P 500, buyers should defend 4,000 level. This is the psychologically important level where a dynamic support line is located. Now there is a likelihood that the price may dip below it. The risk of going deeper exceeds the chance of a rebound this week. The sentiment on Wall Street will depend on fresh economic reports. The Fed meeting minutes and speeches of Fed officials will be in the spotlight. Investors will also keep an eye on U.S. personal income and spending data, the PCE price index, and revised GDP for the fourth quarter. Watch this video till the end and find out more interesting details. Please leave your comment down below. Let's start. Inflation in the US remains stubbornly high. The labor market is tight. However, the economy is resilient. Given the economic reports and the hawkish rhetoric of Fed policymakers, the central bank is likely to stick to aggressive tightening for a longer time. For example, Cleveland Fed President Loretta Mester said that she saw a compelling case for rolling out another 50 basis point rate hike. St. Louis Fed President James Bullard also admitted such a likelihood. Thus, the sentiment in the stock market turned sour due to the possibility of new aggressive rate hikes. Nevertheless, stocks managed to recover even amid the ongoing tightening cycle. Recently, investors have been pinning their hopes on the end of monetary tightening. They believed that the key rate would soon reach a restrictive level. It was the main reason for a rally on Wall Street. It seems that traders should revise their strategy again. The interest rate may soon exceed the 5% level. Analysts are sure about it. It's likely to stay above 5% for a very long time against the background of an overheated labor market and strong consumer demand. Near 82% of investors believe that in May the rate should reach 5.25%. In June, the Fed could hike it to 5.5%. Only at the July meeting, the regulator could make a decision to take a pause. However, this is just speculation. At the moment, the majority of traders are factoring in a rate increase to 5.5%. Less than 20% of investors assume that the central bank could bring the benchmark rate to 5.7%. The rate may be raised by at least 75 basis points from 4.75%. For stock markets, it means turbulent times. In the next 6 months, the shares are likely to be rather volatile. One can only dream of a steady upward movement. Despite the overall downward trend, the Dow Jones logged the best performance last week. Last Friday, it even managed to gain 130 points, while other indices went into negative territory. Nevertheless, it did not help the index to remain in the black. Over the week, the Dow lost 0.8%. The Dow and the other stock indices kicked off the new week in the red zone. Speculators are concerned about the Fed's aggressive rate hikes. Monday was a day off in the US. For this reason, traders might have opened positions according to the trends of last week, although the trends of the new one are unlikely to change significantly. Opinions of investors are now polarized. Some of them are sure that bear market has finally ended in January. Others are casting doubts on such a scenario. If we look at the numbers, there are a few optimistic analysts on Wall Street who are sure of the end of bear market. A poll conducted by Bloomberg at the end of January showed that about 70% of respondents do not rule out a new downward movement. However, they believe it will hardly be as strong as it was last year. They are confident that the stock market has not reached the bottom yet. The S&P 500 index has dipped by 25% from its high. It is expected to rise to 4,200 by the end of the year, which is a rather modest growth. There are no signs of a steady rally due to the lack of drivers. The S&P 500 index fell by 1.1% last week. The new week will hardly bring positive shifts. Bulls need to protect 4,000 level. The index has already dropped below 4,100, which opens the way to 4,000. The S&P touched 4,050 some time ago. After that, it rebounded to 4,080, but not for long. The medium-term downtrend seems to come to an end. However, it has not been fully confirmed. A bearish bias is still possible. A breakout below 3,930 will facilitate bearish sentiment. Unlike forex, the stock market did not react sharply to signals about the upcoming aggressive rate increase. Stocks might have found some support amid rising inflation and a less inverted yield curve. It means that a recession is unlikely to occur in the near term. Inflation has become a constant headache for the Fed. The CPI is declining, albeit at a slower pace. The reading again missed their forecasts, so the Fed needs to take more aggressive measures. The producer price index was also down, but it soared to 0.7% on a monthly basis, exceeding the forecast reading of 0.4%. It also surpassed its previous level of 0.2%. The CPI changed slightly while the PPC rose dramatically. Thus, inflation may advance again in 1 or 2 months. A jump in the prices of goods and services could also boost inflation. Retail sales in January increased by 3% compared to December. At that time, the indicator sank by 1.1%. Therefore, there are lots of factors that may push inflation higher. The Fed needs to act more aggressively to cap soaring consumer prices. This is bearish for stocks. This is why investors should be more realistic. In other words, they should not expect a policy reversal in the near future. The high-tech NASDAQ 100 also closed last week with a 0.6% drop. The prospects for the new week are not bright as well. The index may also dip lower due to expectations of aggressive rate hikes. Investors took notice of inflation and other U.S. economic indicators. Before the release of economic data, only 9% of traders saw the Fed funds rate target at 5.25%. At the same time, 91% of investors priced in a rate increase to 5%. Now the restrictive level for the middle of the year is 5.5%. It gives food for thought. As for the NASDAQ 100, if it slides below 11,625, sellers will push it down to 10,820. JP Morgan indicated the signs of a downward movement, calling the NASDAQ's rally a junk rally. Since the start of the year, the index has advanced by 14% after a 33% slump last year. Its growth was stimulated by the shares of software developers, crypto companies, electric car manufacturers, and firms related to artificial intelligence. Interestingly enough, before that, these stocks were the least profitable ones. When worst performing stocks show the best results, it usually leads to a rapid reversal. What's more, the NASDAQ has been able to surpass the S&P twice in terms of growth since the start of the year. Tech stocks included in the S&P are trading close to the peaks of the dot-com bubble. This is an alarming sign for tech sector. Hedge funds' bearish bets on tech stocks have reached the second highest level in the last decade. Against the background of the aggressive rate hikes, a wave of sell-off may occur. The Fed's future plans for monetary policy will be the main driver for stocks as the earnings season is almost over. According to the preliminary results, 68% of companies have earnings per share above the forecast. At the same time, the reading remains below the 5-year average of 77%. This week, Walmart, Home Depot, Nvidia, and eBay will publish their earnings reports. The results may be good, but they will hardly cheer up investors. If the figures turn out to be strong, the Fed will have an additional reason to further tighten policy. That is all for now. Hit the subscribe button to keep abreast of the latest market news. See you!